Welcome back to our YouTube channel. Topic that we will be having a look at today is from FRM level 2, and it's from credit risk measurement and management, and it's from chapter CVA. And the topic is also how do we calculate credit valuation adjustment. So let's have a look. And yes, before we go ahead, please do subscribe to our channel, share with your friends and peers who are appearing for level 2 exam. Takes a lot of efforts to come up with videos like this. So please do subscribe. So this is a question, bit lengthy one. Let me read it for you. A CRO at an investment bank has asked the risk department to evaluate bank's derivative position with a counterparty over 3 years. Of the risk department assumed that counterparty's default probability follows a constant hazard process. The table uh, present the trade and forecast data for TGA spread and expected exposure and recovery rate for the counterparty. So we have been given expected exposure. Of course, it's a positive. That's why we are calculating CVA and the CDS spread and recovery. If there is a default, what is a recovery, and whichever would be a loss given default, on that we would be calculating CVA, not really on the recovery amount. So these are given in the table. And additionally, CRO has represented his team the following set of assumption to use in conducting the analysis. The investment bank and the counterparty have signed CSA to cover this exposure, which requires a collateral posting of Australian dollar 11 million, and the current risk-free rate is 3%, and the term structure rate remains free over flat over 3 periods horizon. So risk-free rate is constant at 3%. The collateral and expected positive exposure value remains stable as a project over 3 years life of the contract, and the expected positive exposure and the collateral are assessed by using the same discounting factor. The probability of default of the bank is 0 per year. So eventually it's for more for a DVA, not really for CVA. So this last point is not that relevant from the CVA perspective. Given the information and the assumption above, what is the correct estimate for unilateral CVA for this position? So these are the options. Let's see how do we solve it. So this is a form. These are the three formula that we would be using in calculation of CVA, because certain things are not directly given to you. You have to calculate it. So the credit value adjustment is a summation of your loss given default times expected exposure times your probability of default. So over here, very important to note is this probability of default is a marginal probability of default, and of course discounting factor from where from the projected cash flow you have to bring it down to the present value, and hazard rate that we would need to so basically the flow is like you need to calculate hazard rate. From hazard rate you can calculate cumulative probability, and you can calculate marginal probability from the cumulative probability. We'll see this in detail. Let's stay tuned with the video. So hazard rate is CDS spread over your loss given default, and your cumulative probability is 1 less exponential of negative hazard rate times your time. So like we would calculate lambda first, then we would calculate cumulative probability, and likewise we can calculate marginal probability. So let's see how do we solve it. So just to summarize, first we have to calculate the net exposure because there was certain collateral that was posted. So we had to calculate net exposure first. Then using this formula, we had to calculate hazard rate, then marginal probability. So this is what we need. LGD is directly given to you, or recovery is given. We can just directly calculate LGD. Net exposure we have to calculate. It's just marginal probability and discounting factor, wherein it's bit of calculation part. And discounting factor is also easy, but probability of default, first you have to get hazard rate. From hazard, you have to calculate cumulative probability, then marginal probability. So hazard rate, marginal probability, discounting factor, and then we directly can calculate the CVA. So just summarizing the information that is given in the question. So initially exposure is E, that is 14 million Australian dollars, and CDS spread is in basis point. So for year one, CDS spread is 200 basis point. For year two, it's 300 basis point, and for year three, it's 400 basis point for your counterparty or counterparty of the bank. So, and recovery rates are 80, 70, and 60 for year one, two, and three, respectively. So, and collateral that needs to be posted as per the CSA agreement is 11 million Australian dollars. So if you noted, exposure is 14 million and collateral is 11 million. So your net exposure would be 3 million Australian dollars. And very important point, this row I will come back in a minute. And for hazard rate, you can see that it's a formula CDS spread, which you see over here. It's in basis point, and your 1 minus recovery rate, that is LGD. So it's 80%. So in denominator, it would be 20%, and its numerator is 200 basis point. So if you calculate this, it would be 10%. Likewise, over here also it's 10%. And for this year three also it's 10%. So we have directly written 10% over here. And discounting factor can be calculated like exponential of times your risk-free rate. So for year one, it would be 1 times your 3%, 2 times 3%. And numerically, it would be these numbers at the last row. So coming back to this row, let's see how do we calculate this. So first we will calculate cumulative probability, which is 1 less exponential of your hazard rate times your it's lambda t. So your lambda is 10% and time is first year. So it's 9.52%. So for year one, there is no prior probability of default. So your cumulative probability is a marginal probability of default itself. But for year two, you need to calculate cumulative probability first, then cumulative probability of year two less your cumulative probability of year one will give you a marginal probability for year two. In a similar way, we can calculate marginal probability of year three by calculating cumulative probability of for year three less your cumulative probability for year two. So these are the respective marginal probabilities. Be careful with calculation of this. There is a chance that you may go wrong somewhere. And this is a row 9.5 to 8.61 and 7.79. So these are your marginal probability of default. So what next? We have everything. We just need to play in the formula of CVA. So for year one, your recovery rate is 80%. So your loss given default would be 20%. And your exposure, net exposure is 3. And your marginal default probability is 9.52%. And of course, discounting factor. Likewise, it has been plugged in for year two, wherein we have a loss given default of 30%, net exposure 3 millions, and your marginal default probability is 8.61%, and discounting factor. Likewise, for year three, we have recovery rate of 60%, so loss given default would be 40% of 3 million Australian dollars times your marginal default probability for year three is 7.79% times your discounting factor. So if I just calculate and sum these up, it's approximately 0.21384 million Australian dollars. So this is your credit value adjustment. So if we look at the options, it was option A, Australian dollar 0.214. So it's rounded off till third decimal place. Hope you like the video. If yes, please do share with your friends who are preparing for level 2 exam. Subscribe to our channel, and yes, stay connected with the channel. And yes, at our institute, we stimulate your thought process to enhance your learning. So get in touch with our team if you are looking for coaching or any kind of guidance for your FRM preparation. Yeah, lastly, once again, a request to subscribe to our channel. Stay connected with the channel. Thank you.